DeFi promises high yields, passive income, and the dream of financial freedom. But let me share an uncomfortable truth with you. Most DeFi tokens actually underperform over the long run. And the reason isn't the technology, the code, or the team. It's the tokenomics. In this video, we're going to pull back the curtain on how DeFi tokenomics really works. And more importantly, how so many investors get trapped by the allure of high yield. Let's start with the foundation. Decentralized finance, or DeFi, completely changed how we interact with money. It cut out the middlemen. It enabled borrowing and lending without asking for permission. And it created brand new ways to earn rewards. But from an investor's point of view, DeFi also created a new problem. It introduced incentives that often prioritize explosive growth over long-term sustainability. If you want to avoid the common mistakes that trip up most people, understanding DeFi tokenomics is absolutely essential. Now, let's talk about one of the most important and most misunderstood mechanisms in all of DeFi. Liquidity mining. This is the process of rewarding users with new tokens for participating in a protocol. You might get these tokens for providing liquidity to a trading pair, for staking your assets, or just for actively using the platform. At first, this seems like magic. It creates incredibly rapid growth. User activity explodes, liquidity pours in, and the project gets a ton of attention and hype. But there's a hidden cost that most people don't see. Liquidity mining also creates constant selling pressure. Think about it. People are getting free tokens, so what do most of them do? They sell them. It also leads to what's called high token velocity, where tokens change hands very quickly instead of being held. And finally, it creates inflation-driven dilution, meaning your share of the network gets smaller as new tokens are printed. In simple terms, liquidity mining often trades long-term value for a short-term marketing boost. Let's look at the kind of behavior that these high yields attract. When you see a project offering yields in the hundreds or even thousands of %, it doesn't just attract loyal users who believe in the project's future. It attracts yield farmers, short-term mercenary capital, and speculators. These participants follow a very simple and predictable cycle. They farm the rewards. They sell them immediately for stablecoins or other assets, and then they move on to the next hot project. This behavior cranks up the token velocity and puts a constant downward pressure on the price. Remember this. Yield without user retention is a recipe for destroying value. Next up, let's talk about emissions. Most DeFi protocols distribute their tokens through an emission schedule. This just means that new tokens are constantly being created and given out to users as rewards. Now, basic economics tells us that if supply increases faster than demand, the price is going to fall. However, emissions are not always a bad thing. They can actually work if a few key conditions are met. First, the emission schedule should decline over time, so the rate of new supply slows down. Second, they need to be offset by real, organic demand for the token. And third, they should be structured to reward long-term participation, not just short-term farming. If those conditions are missing, you often see the token's price slowly bleed out over months or even years. This is exactly why every single investor should check the emission schedule before putting any money into a DeFi project. Now, let's compare two very different things. Revenue and inflation. The strongest, most resilient DeFi protocols generate real revenue. They earn fees from activities like trading, borrowing, or other services on their platform. Rewards that are backed by this real revenue are infinitely healthier and more sustainable than rewards that are only backed by printing new tokens, which is just inflation. So, whenever you're looking at a project, ask yourself these three critical questions. First, does this protocol actually earn fees from its users? Second, do the token holders somehow benefit from those fees, maybe through a buyback and burn mechanism or direct revenue sharing? And third, is that revenue actually growing over time? If the rewards are only coming from inflation, the high returns you think you're getting can be very misleading. Let's touch on governance tokens. Many DeFi tokens are primarily designed for governance. This means they give holders the right to vote on important decisions about the protocol's future. In theory, this sounds incredibly valuable. Who wouldn't want a say in how the platform is run? But in reality, the value is often much less than it appears. Only a tiny percentage of token holders ever actually participate in voting. This often leads to power becoming centralized in the hands of a few large holders, or whales. And frankly, many of the governance decisions have very little direct impact on the token's value. Governance without a clear mechanism for value capture often results in very weak tokens. So, what are the major red flags you should be looking for in DeFi tokenomics? Be extremely cautious if you see things like this. Yields that are unsustainably high, an aggressive emissions schedule that's flooding the market with new tokens, a token whose only utility is earning more of itself, or a project where all the demand seems to disappear the moment the incentives are reduced. These systems are like a house of cards. They usually collapse once the incentives dry up. On the other hand, sustainable DeFi tokenomics usually share a few key traits. They have a declining emissions schedule. They generate real fees from their product. They have clever ways to reward long-term holders over short-term speculators. And they provide a clear and understandable method for value capture, linking the protocol's success directly to the token's value. These projects might grow a little slower, but they are built to last. Here's a common beginner mistake I see all the time. New investors look at a project and assume that high yield automatically means high returns. But yield is not profit. True profit comes from a combination of sustainable incentives, a controlled supply, and genuine, long-term demand. The principles of DeFi tokenomics make this difference crystal clear. In our final chapter, we're going to bring all of this knowledge together. We'll dive deep into the most common tokenomics red flags. Learn exactly how to evaluate a project before you even think about investing, and build a complete framework for any crypto investor. This is where your knowledge turns into actionable strategy. In DeFi, the market rewards understanding, not greed. If you found this breakdown helpful, make sure to subscribe and stay tuned for the rest of the series. In Part 10, we'll reveal the biggest tokenomics red flags to watch out for and give you a full evaluation framework to help you become a smarter, long-term crypto investor. Thanks for watching.